Amid global economic turbulence and renewed market jitters over Trump-era trade policies, Mastercard posted earnings that beat analyst expectations. CEO Michael Miebach made it clear this wasn't luck. It's the result of a resilient business model and consistent risk strategy. While many companies are still reacting to the AI wave, Mastercard has already launched an AI-powered shopping agent. At the same time, they have remained strong in their traditional segments like cross-border payments and value-added services, showing a clear balance between innovation and core execution. In this video, we are going to break down Mastercard's first quarter 2025 financial results, run a valuation estimate, and look at how well positioned they are for an AI-driven future of commerce. This is not financial advice. No buy, sell, or hold recommendations. Always do your own due diligence. Mastercard's first quarter performance was solid, despite a global backdrop that remains uncertain. Earnings per share came in above expectations, driven by healthy revenue growth and continued strength in consumer spending. That revenue came primarily from two areas. Core payment network activity still at the top line, but value-added services, including security tools, analytics, and authentication, are growing even faster. It's a signal that Mastercard is deliberately shifting from a pure transaction fee model to more tech-enabled solutions that can scale beyond cards. On the cost side, operating expenses were up, mainly from general and admin, along with a noticeable bump in advertising and marketing spend. Still, margins remain intact, showing that Mastercard continues to operate efficiently even while investing more aggressively to strengthen its brand and expand globally. The increase in expenses isn't just about defending market share. It reflects a proactive push to stay ahead of the competition. Transaction volumes processed through Mastercard network continue to grow steadily. Usage remains strong across markets, and the number of active cards in circulation also keeps rising, a sign of sustained trust and adoption around the world. Interestingly, the fastest growth came from cross-border activity, especially online, non-travel related commerce. That's a clear indicator that cross-border digital spending is still accelerating, and Mastercard is positioned right at the center of that flow. Meanwhile, total purchase volume saw healthy growth, though slightly below market expectation. Still, the broader numbers reflect strong consumer buying power and a well-diversified global footprint. Lastly, Mastercard revised its full-year revenue outlook upward. Originally forecasting a more conservative growth rate, management now expects growth in the low teens, a reflection of their confidence in market conditions and their strategic execution so far. Now let's talk valuation. I use a discounted cash flow model with moderate assumptions. Starting with first quarter data and adjusting for capital expenditures, annualized free cash flow comes in around $8.72 billion. I applied a 12% annual growth rate over 5 years, which is reasonable for a company like Mastercard, a 3% terminal growth rate, and a discount rate WACC of 8%. Based on this model, the fair value of Mastercard stock lands at roughly $285 per share. That's still well below its current market price, which is trading above $560. So why the huge gap? It really comes down to how the market values Mastercard's quality. Together with Visa, they form a global duopoly in payments, and they don't just own the pipes. They've built regulatory muscle, deep institutional relationships, and brand trust that hard for any new player to replicate. Their business model is also incredibly efficient, asset-light, high margin, and almost all of their earnings convert cleanly into free cash flow. On top of that, they consistently buy back shares, adding long-term value per share over time. But perhaps the biggest factor But perhaps the biggest factor, and one that traditional DCF models often overlook, is Mastercard's exposure to AI-driven commerce. This company isn't just talking about AI, it's building it into the consumer journey. With systems like Agent Pay and AI-integrated shopping flows, Mastercard isn't just enabling payments, it's embedding itself into how decisions are made. That makes their role in future digital commerce far more foundational than current cash flows alone would suggest. Mastercard is making it clear they are not just surviving the shift to AI, they are helping lead it. While many financial firms are still trying to find their place in the generative AI ecosystem, Mastercard has already embedded into real consumer use cases. The battle isn't about who owns the most cards anymore. It's about who's most relevant in how people shop, decide, and pay. What sets Mastercard apart isn't just the tech, it's their global position. They can roll out innovations at scale with trusted partners across markets. That kind of reach and regulatory alignment is incredibly difficult to copy. So yes, the stock might look expensive on paper, but the market isn't just buying current cash flow. It's buying dominance in digital future that's already unfolding. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. I'll see you in the next one.